Welcome, investors. In today's briefing, we're taking a closer look at Tesla, stock ticker TSLA, through the lens of its Q1 2025 Form 10Q filing. We'll examine the fundamentals behind the current consensus hold rating while contrasting it with the more bearish sell perspectives from select analysts. By the end of this analysis, you'll have a clearer understanding of why the latest financials appear to reinforce the analyst rating for maintaining a neutral stance on Tesla. Disclaimer: the following content is for informational purposes only and does not constitute financial advice. It should not be relied upon for investment decisions. We strongly recommend seeking independent, professional financial advice before making any investment. Always remember, investing involves risk. Tesla's Q1 2025 financials revealed several key takeaways. Total revenue declined by 9%, primarily driven by a 20% drop in automotive segment revenue, substantially impacting overall profitability. This weakness was partially offset by a strong performance in the energy segment, where revenues surged 67%. Accompanied by improved gross margins. Research and development expenses rose by 22%, reflecting increased investment in the company's AI initiatives. However, the most striking figure was the sharp decline in operating income, which fell 65.9% year over year to $399 million, down from $1.17 billion in Q1 2024. Tesla reported Q1 2025 revenue of $19.34 billion, down 24.7% from the December quarter. Cost of sales declined proportionally by 24% to $16.18 billion, resulting in a gross profit of $3.15 billion, a 24.5% decrease quarter over quarter. Year-on-year comparisons also show a notable decline. In Q1 2024, Tesla posted $21.30 billion in revenue and $4.44 billion in gross profit. This marks a 9.2% drop in revenue and a 28% decline in gross profit compared to the same period last year. Operating expenses rose modestly by 2.5% quarter over quarter, from $2.60 billion in December to $2.66 billion in March. As a result, operating income fell sharply to $493 million, down 68.9% from $1.58 billion in the previous quarter. Tesla's balance sheet reflected several areas of concern in Q1 2025. The current ratio declined slightly from 2.02 to 2.00, while the quick ratio fell from 1.42 to 1.37, indicating a modest weakening in short-term liquidity. Total assets increased by 2%, driven primarily by a 14.1% rise in inventory, largely a result of slower sales. Additional contributors included a 2.4% increase in net property, plant, and equipment, and a 20.2% rise in other long-term assets. However, total liabilities also rose by 2.7%. This was led by an 8% increase in accounts payable, a 6.4% rise in accrued expenses, a 6.6% increase in other non-current liabilities, and an 8.8% increase in non-current unearned revenue. These movements suggest growing obligations across both short and long-term liabilities. To begin, it's important to acknowledge the headwinds that underpin some analysts' bearish or sell recommendations on Tesla. The company's Q1 2025 results present several concerning indicators. First, vehicle deliveries declined 13% year over year to approximately 337,000 units, an early warning sign confirmed in the 10Q filing. Automotive revenue fell by a substantial 20% compared to Q1 2024, contributing to a 9% decline in total revenue. Net income attributable to common stockholders dropped sharply to $409 million in Q1 2025, down from $1.39 billion in the same quarter last year, raising red flags about downward pressure on earnings per share forecasts. Regional revenue breakdowns add further context. Sales in China declined to $4.30 billion from $4.59 billion year over year. Meanwhile, other international revenues, which include markets such as Europe, fell significantly from $6.9 billion to $4.7 billion. These figures reinforce concerns around global demand. Notably, Tesla's own 10Q cautions that uncertainty in the automotive and energy markets continues to increase, posing risks to our global supply chain and cost structure. This aligns with broader macroeconomic challenges such as inflation and rising interest rates, which are impacting both affordability and demand. Viewed in isolation, these top-line metrics make a compelling case for a more cautious or even bearish stance. But this is where a deeper reading of the 10Q reveals important context and makes the case for a more nuanced, balanced view. While top-line challenges are clear, the underlying financials also highlight areas of strength and future growth that help justify a hold rating. The decline in Q1 vehicle deliveries, for example, is explained directly in the 10Q. Tesla states it brought down all of our vehicle factories simultaneously for the changeover to new Model Y, resulting in several weeks of lost production. This points not to weakening demand, but to a temporary operational pause tied to a strategic product refresh. In terms of regional sales, while international revenues declined, U.S. revenue actually increased year over year, from $9.76 billion in Q1 2024 to $10.33 billion in Q1 2025. This undercuts the bearish argument of a global sales collapse and instead suggests a more varied geographic performance. Another key strength is Tesla's energy generation and storage segment. This business line saw revenue surge 67% year over year in Q1 2025, with gross margins improving from 24.6% to 28.8%. This highlights Tesla's growing diversification beyond automotive and its potential to become a more balanced, multi-segment business. Tesla is also clearly leaning into long-term innovation. The 10Q emphasizes a strategic shift toward AI, robotics, and automation, with the company stating that the next phase of production growth will be initiated by advances in autonomy, including the upcoming purpose-built robotaxi product, Cybercab. Supporting this focus, R&D spending rose 22% in Q1, primarily due to investments in AI-related programs. These initiatives represent high-risk, high-reward growth levers, and the scale of investment suggests Tesla is serious about leading in this space. Importantly, despite the drop in net income, Tesla generated strong operational cash flow. Net cash provided by operating activities jumped to $2.16 billion in Q1 2025, up from just $242 million a year earlier. This significant increase reflects underlying business resilience and the ability to self-fund future growth. Noting, however, that the December 2024 quarter operating cash flow was $4.81 billion. Finally, Tesla reaffirmed its commitment to long-term expansion, guiding for over $10 billion in capital expenditures in 2025. These investments will support factory growth and AI infrastructure, demonstrating the company's continued focus on scaling its global footprint and next-gen technologies. Taken together, these data points support the view that Tesla remains fundamentally strong and strategically focused. In summary, while Tesla's Q1 2025 10Q clearly reflects near-term challenges, particularly in vehicle deliveries and net income, it also provides important context and surfaces notable areas of strength. The decline in automotive performance is partly attributable to strategic production adjustments for the new Model Y, rather than a fundamental drop in demand. Meanwhile, the energy segment is delivering strong growth and margin expansion, helping to diversify Tesla's revenue base. Crucially, the company continues to invest heavily in its long-term vision with a focus on AI, robotics, and autonomous technology. This is backed by a sharp increase in operating cash flow year on year, which underscores Tesla's capacity to self-fund its growth initiatives without over-reliance on external capital. Taking these factors into account, the 10Q supports a hold rating. It acknowledges short-term headwinds, but also reinforces confidence in Tesla's long-term strategy, operational strength, and innovation roadmap, making a hold a more balanced and appropriate stance than a definitive sell. Want more analyst ratings breakdowns like this? Like this video and subscribe to our channel, and visit EBITs Pieces on Seeking Alpha to view our whole list of fully detailed stock analysis. A link to our page is in the description below.